Hello, this is Curtis Mangus with Property Line Today, and for the second half of our show, I have Phil Archer with Fidelity National Title. Phil is a senior escrow officer with 17 years worth of experience, and we're going to talk in the second half of the show about how title insurance works in a purchase transaction. Phil?
Curtis, thank you for having us out.
No problem. If you would kind of explain the overall role of title and escrow in a purchase transaction.
Well, the overall role of the title company in an escrow transaction is somewhat confusing to most people. Oftentimes they don't even understand our role really until the end. So once we get involved in the transaction, you've already met with the lender, you've already been pre-approved, you've already met with your real estate professionals, and oftentimes you're even under contract. So once that contract's executed, it is either sent over to us by the real estate agent or by the lender, and then we start our process. And what we go into effect is we do the background research both on you as an individual, the seller as an individual as well, and involved in the transaction, and then the property all the way back to patent or back to when the state of Idaho was granted that property from the federal government. So we search it to find out anything that could be recorded or lienable that would affect the property in any way, shape, or form, and we make sure that all the information is sent out to everybody so that they have a clear understanding of what you're purchasing in that transaction.
And so you're doing the research to make sure that the title of the property ends up clear in the purchaser's name, and that the only lien on the title is the lender in first position.
That's correct. And usually what oftentimes most people get confused about is the word title, and they think of it as like they do a car title. And when you buy a car, somebody issues you a piece of paper that's got your name on it and it says that you own that piece or that car. In a home title, it's a little bit different and involved in that transaction. So we issue an insurance policy both to you as an individual that protects your interest in that property, as well as one to the lender that protects their interest. And then we issue you a deed, and the deed is your actual proof of ownership to that property.
And so there's a difference between a car title and a real estate title. One of them is the car moves.
Correct.
And the car can get away.
Yeah.
But the real estate stays.
Well, yeah, we joke all the time in our industry about how it's amazing that you can, buy a car and sign your name 2 or 3 times, but you buy a house and you sign your name 100 times, and which one of those is easier for the lender to find?
Right, and on the other hand, you can buy a car in a few hours in an afternoon, and it often takes 30 to 45 days to buy a house.
It does, absolutely. And there's a lot more that goes into the back research of the property. And the back information is very timely for us to locate that information with the counties, and then for us to put that into a respectable form that both the lender's going to understand and know that they're comfortable in their insurance position. And
so you have a standardized format that reports all the liens and encumbrances of the title.
We do.
Of the property, as who owns it, who's on title, what liens are out there, and how the title needs to be, quote, cleared, so that when the new purchaser buys it, it ends up in their name and the lender is in first position.
That's correct. And there's so many people involved in the transaction from the beginning to the end that really are involved in doing the background research. So from the title officer who does all the background research with the county to then produce that report that we then provide to everybody that shows everything that has to be cleared, to the escrow assistants and the staff on hand that need to then clear all of the items to make sure that it's all what everybody expects, from sewer liens and water and irrigation to HOA liens, payoffs to the underlying lenders. And then we get into things that are not on every transaction, but the things that come into play, such as tax liens and judgments and child support liens and many things like that affect the validity of the title from beginning to end, and really come into play as a both buyer and seller, so you have a clear understanding as to what you're purchasing in this transaction.
And so what title insurance does is it insures, first of all, that when the individual buys the property that they're in first position, but it also insures the lender, because they're the ones at risk, to make sure that they're in first position in case the buyer defaults, that they can go ahead and foreclose and sell the property and, at least in theory, get their money back and recoup their loss or their principal back on the loan. And so it's very important to a lender that title insurance is issued. It shows that they're in first position and that all of those liens or encumbrances are cleared so that they are properly protected.
Absolutely, and we as a company also want to make sure that that research is done accurately, because ultimately the lender's recourse comes back on us as a company. We're ensuring that that clear title is given to them so that they have a position in case of a foreclosure that they need to go back, that they can take that property back free of any additional items that they have to pay off. Right. And if any of those items come up, either against the buyer or the previous seller, that's where your title insurance comes into play. So like a lot of the insurances that you deal with on a daily basis or even in your lifetime, it's something that you never are aware of ever until you need it. And when you do need it, that's what we're there for.
And so title insurance is one of those things, as I guess is most insurances, that you need to have but hope that you don't need to use.
That's correct.
But when you need it, as with most insurances, you really need it. And so the upfront underwriting in title insurance is done hopefully to eliminate the risk not only to the lender and the individual, but also to the title company, to make sure that those liens and encumbrances and all those things of record that are out there won't come back to, quote, haunt them later, correct?
Correct. And the things that you hear about most often in our industry that are on the news or in the papers talks about people buying their houses again. You know, they purchase their property and then they come to find out that there are liens or mechanics liens out there that the builders or sellers never paid for. And those liens then attach to the property. So if your seller or your builder goes out of business and they never paid those underlying loans or those bills, they have recourse and it comes back to the homeowner. And if you don't have title insurance, then that recourse then falls upon you as the homeowner. If you do have title insurance under certain coverages of our stuff, under certain coverages of our plans that we offer to our customers, you can come back to us and we can either determine whether or not those are covered, whether or not they're viable liens, whether or not we're going to litigate them on your behalf, whatever we can do to help you clear those matters up so that they don't cause you heartache later on down the road.
And then there are some liens that are attached to the property, but there are also liens that follow individuals, correct?
Yes.
Probably the most common types of liens that would follow individuals would be state and federal tax liens and probably back child support.
Yeah, so the three most common are the state and federal tax liens, which you discussed. Back child support is a big one that is a lienable issue regardless of whether or not you're delinquent. So a lot of people in the state of Idaho are under the impression that it's only a lienable issue if you're delinquent in child support. But actually, if you have an obligation to pay child support under Idaho statute, there's a lien automatically filed against your name. So when we did a name search on any individual involved in a transaction, if you paid child support, we would show a lien against your name that would affect the title validity of that property. Now, if you're current on your child support, we just obviously contact the county or the state. They tell us that you're current on it, and it's an insurable issue. We just insure right around it. If you're not, or you have back child support, oftentimes that has to be cleared up before you can purchase and definitely before you can sell that property. And then the third item that comes up often is judgments. And judgments come into effect when you have back credit card debt that isn't paid off and you're sued in court. They get a judgment against you, and those attach against your name as well as your property. So if you're buying a property and you don't own any other homes, when we do a name run on you, if you've had past judgments that were filed against you, whether or not they were included in a bankruptcy, depending on how they were released, those may show up on title and affect the validity of whether or not you're able to purchase.
And so let's talk about if somebody has filed a bankruptcy and they have liens and judgments out there. Some of those can be discharged in the bankruptcy, correct?
That is correct.
And some of them cannot.
They all can be discharged in the bankruptcy under Idaho statute, under the federal statute for bankruptcy law. The problem is that many of those judgments are considered unsecured debt. So if you have a credit card that you choose not to pay or that you're unable to pay and it affects you in a bankruptcy, if prior to that bankruptcy that creditor is issued a judgment against you, that's no longer an unsecured debt, it's now a secured debt. So depending on where your attorney lists that debt in your bankruptcy as whether or not it's secured or unsecured, is whether or not that judgment is released at the time that the bankruptcy is discharged.
But you can't discharge federal tax liens, correct?
You cannot. Tax liens cannot be
delinquent child support either, correct?
No, you cannot. Those are what they call, those are debts that are not able to be
non-dischargeable.
That's correct.
Right,
yes.
and so there are some, I guess you would say, some complicated issues with title insurance, depending on how involved it gets. If you've got a bankruptcy out there, it certainly requires a lot more underwriting to get to the bottom of it and be able to clear the title.
Correct.
Especially if somebody's buying a property and the seller has filed bankruptcy.
Right.
Depending on what's been discharged, what liens and judgments are against the property, it could take a while for them to get cleared. And I'm assuming there are times when a property can't be cleared.
It does. It's just very, very seldom are we ever not able to take care of all of the issues on a title prelim to clear it so that we can get it closed. The key is time, and time is of the most important aspect of it. So when you get into a contractual obligation with both a seller and a buyer, there's essences of time that are important to the closing of that transaction. So both the seller think it's going to close by a certain date, and you as the buyer expect it to close by a certain date, and you begin to plan based on those dates. Well, if we have the information up front and begin our title process early in the transaction, we can then have the time to clear those issues. But if you have a federal tax lien and you have to close in 5 days, that's not easy for us to obtain, especially depending on where the property is located. Obviously, with it being located, if we're closing a property here in Ada County or in the Treasure Valley, we have a federal tax office here, so you're able as a buyer or a seller to go down and obtain a tax payoff directly from the federal government. If we're asked to obtain it, it can take 17 to 21 business days for us to get those back. Well, that can delay a closing immediately, and that can take a lot of time to get that stuff taken care of.
And so when somebody goes out to purchase a property and they set a 30-day close and they start to go through the process, if the seller has tax liens, judgments, or the buyer has things that can affect the title on one or the other or both, obviously those things could take a fair amount of time to be able to clear. And sometimes, to give you an example, if they owe $20,000 to the IRS on a federal tax lien and they don't have the money, we're not going to clear that lien. Is that correct?
Not always. I mean, more often than not, that is the case with federal tax liens, especially with state tax liens. But if there's no more equity in the property, oftentimes we can submit HUD settlement statements to the federal government or the state that will release that property, because there just literally is nothing there to it. So there's no advantage for them to not take at least the proceeds that they can get, because in a bankruptcy or foreclosure situation, they're not going to get anything, because those are going to be liens that attach to the person, not the property, and they go away.
Out of curiosity, if somebody wants to purchase a house, can you do a lien search on that individual before they go and purchase if they're concerned about back child support or federal tax liens? I've, in a few instances, pulled a credit report on people and not had those things show, and had them come up later as an issue when we had done underwriting and credit report and done everything as a lender, but we can't necessarily see things that affect title always.
And we can do most name searches, and we do them for our customers constantly to check whether or not things like that come up. But what we'd prefer to do is to do it involved in a transaction, so that we can then supply an insurable piece that goes along with a contract. So if you're getting pre-approved with the lender, the majority of the things that are going to delay your closing process are going to show up on your credit report. If they don't show up on your credit report, we're going to catch them early enough in the transaction, usually, that we can take care of them and still get you closed. Federal tax liens and state tax liens, you as a borrower or you as a seller are going to know that you have those state and federal tax liens, because you're going to be notified, and you need to make sure that you keep track of those things. Now, people forget, and obviously things come up to where you're not notified properly, and therefore you're not aware that you have them. But usually in those instances, they're small enough, or they're things that are not going to delay the transaction enough that we can't get it closed.
Right. And I encounter from time to time people who've had judgments, delinquent credit cards, moved out and had a landlord dispute, whatever it would be, and sometimes they're 4, 5, 6, 7 years old or longer, and they still show on the credit report.
Right.
And unfortunately, that's a lien. A judgment is a lien that affects title, and that has to be cleared before somebody can buy a house, and often people will forget. They were typically served and didn't go to court, or lost and had a judgment and ended up not paying it. But the problem is people will forget about that 4 or 5 years later, and then it will come back to haunt them at a later date, correct?
Yeah, and what we normally find is that the big ones are not the ones that we're concerned about, because the big ones everybody's aware of. It's the small ones. It's the small claims actions that occur. Landlords are a good example of that. Cell phones were a good example of that for many years, when cell phone bills would become delinquent, and when that was the first income or the first debt that somebody would incur right out of high school or as they began their college career, and then they defaulted on a cell phone bill. Suddenly they go to buy a house 10 or 15 years later, and they still have this judgment or this outstanding debt out there with an old cell phone company. So it is important to keep track of your credit report. As most lenders will tell you, it's important to take a look at that on a regular basis, so that you can keep track of the stuff that is out there and keep it clear, so that you can definitely purchase a home later on.
And if you have questions wondering about tax liens, judgments, wondering if they're on title, or wondering if anything, you can always go. The best place to go is called annualcreditreport.com. It's a free site, national site, where you can go. It doesn't cost you anything. It doesn't show as an inquiry. It's sponsored by all 3 credit bureau agencies, and it's a great place to go to just pull a copy of your report and see if there's anything like that that's on there. And so annualcreditreport.com is the best place to go and get a free copy of your report. 1, you should review it annually anyway, and 2, if you're wondering what's on there, with suits, judgments, liens, that kind of thing. It's a great way just to find out what's on there even before you go and see a lender.
Especially if you have a common name. Common names are, judgments are attached by individuals solely by their name. So when we do a name search, we literally check your name. And if your name is James Smith, odds are there's a lot of James Smiths, some of which may not have paid their bills on a regular basis. So there may be judgments and tax liens against James Smith. So we may need further information, middle initials, last 4 digits of social security numbers, or full social security numbers so that we can clear those items. But if you have a very common name, you need to expect those questions because otherwise your prelim is going to show all judgments until we can get them cleared.
What about father and son, John Smith II, John Smith III?
Juniors and thirds and seniors and all of those issues come into play quite often in almost all purchase transactions. And what we just try to do is, if you're staying abreast as to what you have out there in debt and staying up on your credit report, most of those things won't take place. But if you know that you have a junior that doesn't pay his bills on time, or you have a senior, your father, or a cousin, or a brother, or somebody that has a very similar name to you, or you live in an area that is ethnically driven, that you may have names that are fairly common, and you may have overlaps of people, whether or not they have liens and judgments. All of those can be cleared. It just takes time and phone calls.
Okay, let's talk a little bit about Idaho being a community property state.
The excitement.
Yes, because there are times that can complicate a transaction when somebody is married.
It is.
And they want to do a sole and separate transaction. In Idaho, this can get very complicated depending on the debts of the spouse and that kind of thing. Could you kind of explain how that affects title? I
can. So there's 2 different types of ownership in the state of Idaho. There's a physical interest and then there's a community interest. And both of those issues have to be dealt with in all transactions. So because Idaho is a community property state, marital status is extremely important to, is one of the questions that we ask early in the transaction, and is extremely important both to the lender as well as to us as the title company to how we insure. So if you are married, your property has to be taken one of 2 ways. It has to be taken as husband and wife, wife and husband, or it has to be taken as married sole and separate. If it's married sole and separate, which means it's in one of the 2 spouses' names as an individual, then your spouse or the non-borrowing spouse would be required to execute some documents to relinquish their community interest. And what a community interest is in a foreclosure situation or in a property that is your primary residence, the state of Idaho thinks that you have a monetary interest because that is your primary residence. It's called your community interest, your community property interest. In a foreclosure situation, if that was not relinquished at the time of execution, then the lender that would be attempting to foreclose that primary residence would be required to pay off the non-borrowing spouse, which obviously they're not willing to do. So they're required to relinquish both their physical interest via a quitclaim deed, and then they execute the deed of trust to relinquish their homestead interest. And that's what we're doing within those transactions. In a divorce situation, or in a situation to where you have sellers who were married at the time of acquisition and no longer now are married, but are selling a property, we have to deal with both individuals, regardless of whether or not there's a divorce decree stating that ownership is by one person. If the quitclaim deed wasn't done at the time of the ownership, or at the time of the divorce, both people are still entitled, and both people will be required to execute at the time of sale.
So at times you're chasing down ex-spouses, previous spouses, estranged spouses.
Yes, unfortunately.
In order to be, and what if you can't find them?
Well, there's a couple of ways that we can get around that issue when it comes up. It doesn't come up very often because there's really very few things that we can do to actually get around it. But one of the ways is if your attorney included your legal description in your divorce decree, we can then record the divorce decree and make that a conveyance document to transfer ownership. However, then it makes your entire divorce decree then public, because all deeds recorded, anything recorded in the county is now
public record.
Public record. So then somebody else can access all of your information on your divorce decree, which most people don't want included in
Well, there's some sensitive information, including who got the dog.
Correct. Who got the dog, that's right.
Along with
Kids'
personal
names,
property,
yep,
kids,
all that other stuff.
all of the reason for the divorce.
Divorce, yes.
You know, all of those other indiscretions and infidelities suddenly become public record.
Right, which nobody really wants.
No,
so what we always try to do is err on the side of, let's find the spouse. And we start back with the attorneys that handle the divorce, and we work our way from there. And usually we can locate them. Every once in a while, as we dealt through the short sales and the foreclosure situations, it became more difficult. But we're getting it back under wraps again.
All right. Well, and also when it comes to community property, keep in mind, if you do it sole and separate as far as for the property goes, and you do the loan, there are also ramifications on how that loan is looked at. Because in Idaho, if you do on all government loans, the problem is if you do a loan sole and separate, the problem is we are still going to pull a credit report on the non-borrowing spouse, and any debts that the non-borrowing spouse has, we are going to hold against the primary borrower. So not only are there title issues for going sole and separate if you're married, there are also lending issues that have to be addressed. And so on VA, FHA, and rural development, we're going to pull a sole and separate credit report.
Correct.
On conventional, they don't care.
Right.
You still have to deal through the title issues, but you can do it sole and separate, and we'll just take the individual's debts and the individual's income, and you'll have them sign off at closing, and we can make it work that way. And so because Idaho is a community property state, there are things that have to be dealt with. It's certainly easiest if you just purchase the property joint and stay married.
That's right. Forever.
Forever. All of those things just make the title side of things and the lending side of things so much easier for us to work through.
Right, and you have to remember that interest in property changes over time. So if you purchase property now as sole and separate, and then you go to sell that property in 5 or 6 years, I'm still, as a title company, going to ask that your spouse then execute another deed conveying her interest in that property, her or his interest. And the reason why is because you can reestablish community interest over the term of that mortgage. So it's hard for me to say as a title company the non-borrowing spouse never paid a mortgage payment. Well, if they did, then suddenly they've reintroduced their interest in that property, physical interest. So when they go to sell, I as a title company am usually going to err on the side of asking them to issue another conveyance deed, transferring that property to the new buyer.
So if somebody is married and you go through your due diligence and you ask them that they're married and they say no, they're not, but they really are, do you have a way of finding out?
So that's an excellent question, and it's something that comes up quite often, especially as our laws continue to change in Idaho and in other states. As we deal with marriage issues and common law marriage is a common term that we hear in Idaho that is not recognized in any other way besides people's understanding of what common law marriage is. So we'll have people that come to closing that says, well, we're common law married. Well, common law is not recognized in the state of Idaho. It's recognized for certain issues, but it's not recognized for the IRS, and therefore it's not recognized for property ownership. In a situation to where somebody tells me that they were married on a beach in Mazatlan and therefore it doesn't count in the United States, if you file an IRS tax return as a married individual, then you're a married individual, regardless of whether or not you got married. If you file your tax return with the IRS or with the state of Idaho as an unmarried individual, then you can claim to be an unmarried individual regardless of what kind of piece of paper you have.
Fascinating. So it's your federal tax status that really determines your marital status for the legal part of title.
When there's a question in mind. So normally that's not something that people question. Whether or not you're married is usually a pretty yes or no answer. Legally separated is something that we hear quite often, which is recognized in other states. It isn't recognized in the state of Idaho. Legally separated is still married. You can file as a married, tax return you can file as married filing individual. That's okay, but you're still married under IRS laws. Therefore, you're still married under Idaho law.
So if you're permanently separated and you purchase a property, the separated spouse still has to sign that paperwork.
Must execute a conveyance deed and must execute the deed of trust for the purposes of homestead or execute a non-homestead affidavit. And that creates obviously great concerns for certain people because separated is separated for a reason. So the key is that to make sure your marital status is not an issue of question. Make sure you have a clear understanding of whether or not you're married.
Well, and I agree. We would hope that most people would know that,
would.
For better or for worse.
Right, that's correct.
But when in question, this is why it's so important when you're working with your lender and you're working with your title company that these things about when you're married and you want to go sole and separate, it can get complicated. Not only for the title issue, but also for the lender with pulling credit reports and checking debts on the non-borrowing spouse, that kind of thing. And what if the non-borrowing spouse has back child support and federal tax liens?
Right.
Those kind of things can get very complicated.
They can.
And tricky.
Yes, and then we have state laws that come into effect that change the determining factor of what married is. So then we have that issue that we get to deal with now at this point. And if you purchase property right now and you're same sex, you can purchase property as married, but we're going to issue it as married. You're a married individual, and then the state's going to have to figure out later on, because that law could change. I mean, it could not change, and we just have to issue conveyances so that we can secure to our lenders.
Okay, so let's talk a little bit about probate.
Probate. So probate usually comes into effect, obviously, more often than not in a sale transaction. So when you're buying a property of somebody, and one of the two sellers is no longer with us or is now deceased, there's issues that deal with probate that come into play. Idaho is a non-probate state, but if you wish to convey property in the first 2 years upon that decedent, there is a probate issue that has to be dealt with. So what I always recommend in any probate issue is that you contact your real estate professional. They will put you in contact with the title company that they know and that they trust, and that we can then guide you down that process to make sure it's clear into the understanding as to what you need to accomplish as a seller prior to selling that property. It's very important that you deal with that early and prior to getting that contract for sale.
Okay, very good. So in conclusion for today's show, we've talked about a couple of different types of insurance that everybody has to have in a real estate transaction, especially if you're getting a loan. The first is homeowners insurance, which homeowners insurance protects the structure. If you have a fire, if you have some kind of a serious problem with the property, homeowners insurance and those coverages will not only protect the customer, but they will also protect the lender, and it's one form of insurance that is very important and required, especially if you're getting a loan. The other type of insurance is title insurance, and title insurance is important because it protects not only the buyer, but also the lender to make sure that the title is correct, that their lien ends up in first position, that there aren't any other liens or judgments out there, and everything is done, quote, politically correct with community property and that kind of thing. And both of those types of insurance are very important and required, and it's important for people to understand what the differences in those are, because we often have people confuse those. And then finally, you've got what's called mortgage insurance, and all mortgage insurance is just default insurance that protects the lender if a customer doesn't have 20% down, and that's a different show.
It is a different show.
That's a whole different discussion, but for the sake of today's show, we wanted to share the importance of homeowners insurance and how that works, and the importance of title insurance and what those mechanics are. And so we appreciate you viewing today, and Phil, I appreciate you spending your time here for the second half of the show, and that concludes today's show for Property Line 2.